The REIT market is vast and versatile, with over 1,000 real estate investment trusts worldwide, investing in over 20 different property sectors and 30 plus countries. Therefore, there's truly something for everyone. Some REITs like Realty Income are best suited for income-oriented investors, then some other REITs like Digital Realty are better suited for growth investors, and finally some REITs may even be suitable for speculative, deep value investors. A good example of that would be Medical Properties Trust. However, there is a small minority of REITs that I think would make sense for most investors. These REITs stand out in that they have unique business models that are capable of earning above average returns with below average risks, and therefore they make ideal portfolio anchors to most portfolios. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about two REITs that I think most investors should consider owning today. But before I get into it, I wanted to remind you that we are about to hike the membership rate of our REIT newsletter, High Yield Landlord. The membership will be hiked on the 1st of June, so if you're seeing this video before that, you can still sign up at the reduced rate. There's also a 2-week free trial, so don't take any risk in signing up now to lock in the lower rate. If it's not for you, you can cancel anytime in the first 14 days. You won't be charged anything, and you'll access immediately my full portfolio as well as all my investments in real time. So the first REIT that most investors should consider owning is called Canadian NET.REIT. Its ticker symbol is NET.UN. I think that Canadian NET.REIT is very attractive because it's essentially an early day version of Realty Income. In some of my previous videos, I've explained that I expect Realty Income to be less rewarding in the future because of its now massive size, as well as because the net lease market in the US has now become way more competitive. However, in its early days, Realty Income was one of the best REITs available. It managed to generate 15 to 20% average annual total returns, and it was so incredibly rewarding because it was much smaller in size, it used less leverage, and the net lease market in the US was also a lot less competitive, allowing Realty Income to earn larger spreads over its cost of capital. All of that resulted in faster growth in its FFO per share and higher total returns for shareholders. This brings me to Canadian NET.REIT, which is essentially an early day version of Realty Income. It's tiny in size with a roughly $100 million market cap. It's using more leverage than its American peers with an LTV of about 50%. However, this leverage is conservatively structured with long debt maturities that are well staggered. And finally, the company is able to earn higher spreads than its peers in the US because the Canadian net lease market is still quite a bit less competitive. As a result of all of this, Canadian NET.REIT has been able to grow incredibly fast over the past decade. I'll put a chart on the screen where you'll see its growth in its FFO per share as well as its dividend per share. You'll see that most years it's been double digit, about 2 to 3 times faster than most of its American peers, including Realty Income, NNN-REIT, Vichy Properties and others. And this rapid growth combined with its high dividend yield have historically led to incredibly high total returns. In the 10 years following the Great Financial Crisis, Canadian NET.REIT was the most rewarding REIT that I know of. It earned a roughly 10 times multiple on investors' capital, and that's without even counting the dividend. And I don't think that it's too late to invest in the company. It's still early days, it's still a tiny REIT, and I think that it can keep this going for a few more decades to come. This is particularly true as the REIT is today priced at a historically low valuation due to the fact that it's going through a temporary setback. The surge in interest rates coupled with the crash in the REIT market has made its capital too expensive to pursue new acquisitions, and as a result, its growth has been put on pause. Even then, the REIT was still able to maintain the same level of FFO per share in 2023, and it even hiked its dividend. That's quite phenomenal, all things considered, and I think that the future looks bright if you can look a few years out. Interest rates are expected to be cut later this year or sometime in early 2025, and the management of Canadian NET.REIT believes that this will allow them to return to growth by acquiring new properties. But even if that's not the case and interest rates remain higher for longer, Canadian NET.REIT is in no distress whatsoever. It has no major debt maturities until 2027. Its leases include CPI-based rent adjustments which allow it to capture higher rent growth during times of high inflation like today. Its lease is also relatively short at 6 years, and as they expire, they've historically been able to bump up rents by another 5 to 10%. And finally, the REIT is also retaining about 50% of its cash flow to deleverage and buy back shares. All of that should provide good margin of safety even if interest rates remain higher for longer. And priced at just 8 times FFO, a 20% discount to its net asset value, and a roughly 7% dividend yield, it really doesn't take much growth to achieve strong double-digit total returns. So how I see it is that in either scenario we're likely to do quite well. If interest rates remain higher for longer, yes, Canadian net REIT won't be quite as rewarding as it won't be able to grow as fast, but you'll still earn very significant cash flow. The REIT will pay a big dividend and it will retain half of its cash flow to buy back shares and deleverage to create further value for shareholders. Again, this is priced at 8 times FFO, so that's a roughly 12% cash flow yield that you're earning every year. So you really don't need much growth here to earn strong returns. But on the flip side, if interest rates return to lower levels, as is widely expected, then the REIT should be able to return to its faster historic growth by acquiring additional properties at a positive spread over its cost of capital. Therefore, priced as it is, I think that Canadian net REIT is one of the best opportunities in the Canadian REIT market, and it's one of our largest positions in the international portfolio at High Yield Landlord. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button if you think that this content is valuable? Thank you so much in advance. The second REIT I'm going to discuss now, I've highlighted quite a few times on this channel, but I want to highlight it once more, especially now after Blackstone has recently announced the acquisitions of 2 residential REITs, first Tricon Residential and secondly Apartment Income REIT, both of which were heavily investing in the Sunbelt markets. And so now I'm going to talk to you about BSR REIT, which is my top choice for Sunbelt apartment REIT exposure today. Previously, I explained that Canadian net REIT was uniquely attractive because of its business model that was allowing it to grow at a far faster pace than most other REIT because it has a very small size, it's competing in a less competitive market, and it's able to earn above average spreads over its cost of capital. Well, BSR is a lot more simple than that. In fact, its strategy really has nothing exceptional. It owns apartment communities, it earns steady rental income, and it's not even seeking to grow externally by raising more capital to buy additional properties. But BSR is uniquely attractive because I expect its portfolio to enjoy above average organic growth over the long run. Leading up to the pandemic, the REIT went through a multi-year portfolio repositioning, leading to them selling a lot of apartment communities, and they reallocated most of that into strong Texan markets like Dallas, Austin and Houston, and this is primarily where its assets are today. And I think that these Texan markets are set to enjoy some of the fastest same property NOI growth over the coming decade because of all the following reasons. Firstly, they are enjoying very rapid population and job growth as increasingly many companies and people decide to relocate to Texas, often from coastal states, in order to save on taxes, save on living expenses, business expenses as well, and to also enjoy a more favorable business climate. Secondly, today the rent-to-income ratios of these Texan markets are often about 2 times lower than in the more popular gateway markets, and as now these Texan markets grow in popularity, I expect their rent-to-income ratios to grow closer to those of coastal markets. And this is very low relative to the average household income of roughly $80,000 of its residents. And then the fourth reason why I expect these Texan markets to do especially well is because property taxes are really high in cities like Dallas, Austin and Houston. However, there is now significant momentum towards lowering these property taxes, and this should be a unique catalyst in favor of BSR REIT. Because of all of this, BSR REIT is now guiding to grow its same property NOI by 2% in 2024, even as most of its peers have guided for their same property NOI to drop slightly this year due to the current oversupply. And if BSR is able to keep growing its same property NOI even as the market is oversupplied, this bodes really well for 2025, 2026, 2027 because new construction starts have now dropped to the lowest levels since the Great Financial Crisis. Therefore, the current oversupply is expected to turn into undersupply as early as in a year from now, and I expect BSR to again lead the pack in the recovery. But despite enjoying these above average growth prospects, BSR is actually priced at one of the lowest valuations in the apartment REIT sector. It's even cheaper than its peers, Camden Property Trust and Mid-America Apartment Communities. Currently, it's priced at right around 11 to 12 times FFO, a 5% dividend yield, and a 35% discount to its net asset value. I think that this ultra-low valuation makes little sense in light of the strong fundamentals of BSR REIT. I think that there are 2 other reasons that might be affecting its market sentiment. Firstly, it's a very small REIT, and typically smaller REITs are today priced at even more heavily discounted valuations. And secondly, its primary listing is actually in Canada, despite owning all of its properties in the US. And I think that Canadian investors just don't know as much about how fast these Texan markets are growing. Finally, it's interesting to note here that BSR's management is its biggest shareholder, owning about 40% of the stock today, so they are certainly motivated to unlock this value, and currently they are very busy buying back shares. In the last quarter, they bought over 30 million worth of shares, which is very significant for a company of this size, and I expect them to keep on buying more shares as long as they remain so cheap. Just a couple of years ago, BSR was actually priced at a small premium to its net asset value, and I have little doubt that it can return to such a valuation now as interest rates return to lower levels and its rent growth accelerates in 2025. And for this reason, I think that BSR offers some of the best risk to reward of any apartment REITs today, and it also explains why we hold a large position in our core portfolio at High Yield Landlord. Now, as I said earlier, if you want to access my entire portfolio as well as all my transactions in real time, you can join us for a 2-week free trial. There will be a link to it in the description of this video. And otherwise, once more, if you could please click the like button, that helps me a lot to grow this channel. Also subscribe if you don't want to miss future opportunities. Thank you so much again, and see you at my next one. Bye bye.